Hey, Andy. So I was reading a blog from an insurance salesperson who the person specifically focused on selling indexed universal life insurance. This is the sales of this particular type of insurance have boomed over the last 10 years. It is pitched often as a tax-free retirement income tool with lots of guarantees and no risk of loss. And what triggered, what prompted this video today was one of his recent blogs referred to indexed universal life insurance as a quote-unquote can't lose money asset, end quote. Just not true. I even called the person, the salesperson who wrote that blog. I called his state regulator, didn't rat him out by name or company or anything, but just asked, is it okay that people selling indexed universal life insurance refer to it as a can't lose money asset? And the regulator said no. It's at best that's gray. There should be a lot more disclosure disclaimers around making claims like that. The same person who wrote that blog also has used terms like no risk of loss, principal guaranteed, and other varieties of can't lose money, risk free, etc., which are at best misleading half truths. Hopefully unintentional half truths, but realistically probably intentional half truths. So here's how it works. You've seen, if you've watched my other videos, you know where I'm going with this and what I'm getting at. But with any cash value life insurance policy, the product is first and foremost life insurance. You pay money to an insurance company in the form of premiums, be it monthly, quarterly, annually, however you structure it, doesn't particularly matter. Those premiums go to pay for the cost of them insuring your life. If you were to die while the policy is active, they will pay you out whatever the death benefit is, be it $100 grand, $1,000,000, whatever, doesn't matter. There's a cost associated with that, as there should be, right? No company's going to give you free insurance if you die. That someone's got to pay for it. And in the case where you buy insurance, you're paying the premiums to pay for that insurance. Now, with basic term insurance, very straightforward. You buy a term life insurance policy for 20 years, let's say, and it's a $1 million coverage. If you die anywhere in those 20 years, the life insurance company will pay your beneficiaries $1 million. Done. You have to pay premiums to maintain that policy, to keep it in force during those 20 years. But assuming you do pay premiums, that's it. All your money goes to pay for the premiums. I mean, some indirectly goes to pay for the overhead of the policy and commission of the person who sold you the policy, but you don't directly pay those. You're just paying premiums, done. You don't get any other accumulated benefit or asset out of it. Simply, if you die, you get paid by them. If you don't die, that's it. Policy ends, you paid your premiums, everyone goes their separate ways. Well, with cash value life insurance, otherwise known as permanent life insurance, there's two components. There is the life insurance component, meaning if you die while the policy is in force, you will get the death benefit. There's also a cash value accumulation feature to it. So every payment you make, whether it's again monthly, quarterly, annually, some of it, a decent chunk of it, at least in early stages of the policy, goes to paying the cost of the insurance, right? Because it's first and foremost life insurance. There's also fees and charges. So I just recently reviewed an indexed universal life insurance policy where there was premium charges, policy charges. There's also something called, I think, a policy inception charge or something like that lasted the first 10 years. So there are fees and costs with these things. So whatever money you pay in that doesn't go towards the cost of insurance and doesn't go to the other fees and charges of the policy, the rest goes into this cash accumulation account. So the early years of the policy, not much cash is going to accumulate unless you intentionally overfund the policy, put in more cash than the premium is required. There are limits to how much you can put in. There's something called modified endowment contract. You can't overfund an insurance policy because then the policy will lose its favorable tax deferred status, but a separate issue. So the point is, initially, the cash you accumulate inside the policy isn't going to be large. Over time, it can grow large. And here's where indexed universal life insurance policies come in, and here's the magical pitch to them. Put in as much cash as you can, overfund the policy, the cash value will grow by some interest crediting method where it can't be less. In any given year, the interest you get will not be less than zero. It'll only be something positive, anywhere between zero and positive. And it's referenced off of the returns of some broad index, typically the S&P 500 or some other major market index. So the claim that you can't lose money is referring only to the cash value interest that you get credited any given year. It is 100% true that you will never get less than 0% interest on your cash value interest crediting. It'll only be something between zero and positive. That part is true. But you can't you can't own just the cash value investment like feature of a life insurance policy. That cash value is a secondary ancillary feature to the fact that the product is first and foremost life insurance. And you have to pay for that life insurance as you should. So the scenario I give to people is anytime someone pitches them a product, life insurance that says can't lose money, no risk of principal loss, downside protection, etc., ask the person selling it, if I were to put $10,000 into this policy today, how much can I take out in a year? Guarantee the answer will be substantially less than $10,000, right? So that right there, that isn't can't lose money asset, because while the cash value won't get negative interest, the money you put into the product, where again the product is life insurance, the money you put in can and will be less than what you put in, especially in the early stages. It's only until years down the road that the cash value may build up large enough such that you now have more cash you can access than what you paid in. But definitely in the early stages, it is guaranteed to get you out less than what you put in, unless you die. If you were to die early, then the payout's going to be large. That's what life insurance is. But just from like an accessibility standpoint of while you're alive, right off the bat, you're getting out less than you put in. That's fact. That's so. To call it a can't lose money asset, half truth at best, intentionally misleading, but you definitely can walk away with less money than you put into these products. So therefore they are not can't lose money assets. That's it. Just keep that in mind. There are lots of Wild West pitches for this product. Index Universal Life, like I said, has been all the rage, especially since the financial crisis. It's been pitched hard as a retirement income tool, where ultimately it's just life insurance. It has a cash value you can take out or borrow against, which is more so how these pitches are. Build up cash value, take loans against it, use those loans to supplement your retirement income. That's the pitch. But you can definitely walk away with less than you put into these policies. Don't let anyone tell you otherwise. Alrighty, take care.